So welcome to the every Thursday, at least when we're here, live Edge group discussion. Appreciate you being here. It is June 25th, and in Steamboat, the sun just came out. We had some beautiful rain, which we needed. We'll take all that we can get, which should extend our green summer a little bit. And speaking of green summer, I guess the question is it going to remain green in the market or not? Man, what a wild start to the day. Look, I expected volatility. I pointed out Wednesday in the note that if you looked at tech, semis, generally mega caps, big tech, even, you could look at big tech is the weakest, but you could look at them and say, well, they look pretty good. They look okay. The rest of the market, not so much. And I'll explain, if you're new to doing this, I'll explain what I mean. And the two rules here are, if you would mute yourself while we're talking, I can do it, of course, but we'll just ask you to do that. And then but interrupt me at any point. Since I'm flying solo, you may have to do it. I'll try to watch the chat, but please ask questions. Anything you want to look at some ticker, we can do that. I have three core things to cover. So with that, let me share my screen. I'll start with this. I mean, there are all kinds of things that we could include on the platform because we are a quantitative data analytics firm. That's what we are. We're in the business of crunching the math and the data from the mechanics and plumbing of the market structure. And so, that's what the platform presents. We just boil it down to demand and supply. And generally, when demand is rising and supply is declining, things tend to go well. And then they will hit peaks at predictable points in time. And it's not perfect, but it's a very, to me, effective way to look at the market. So this weird squiggle that looks like a polygraph on the screen. And you might say, well, could you put that on the platform? This is behind the scenes data where we look at demand. And in this case, this is the tech sector from March of 2025 to now. And it's going to squiggle along at about 6. If you took an average over the whole period, it's 5.6. So over that whole period of time, tech has averaged 5.6. Well, what would you expect on a 10-point scale if something is averaging 5.6? Probably it rises, right? To not rise, it would have to average, call it 4.9. And tech almost never does that. But it's really interesting to watch the cycles. And you couldn't make investment decisions with this. That's why we don't include it. But you could certainly get a sense of the cycles of demand. And it's an algorithm that meters how trades get executed. And so it's all of the money. And it all has different purposes and time horizons, but it works like this. You have this really tremendous steep drop all the way below 2 in demand back in the tariff tumult, and then the extreme explosive rise in demand that gradually petered out into about November. And then we had another strong period, and then it was terrible into about April 1st, and then we had this huge burst, and here's where we are now. Right? So, demand is rising. I don't know what that's going to do. Is it going to be like this, where there were other big spikes? I mean, this was a huge spike. It's as good as it was there, right? And we've seen that driven almost entirely by chips, the AI trade. I don't know what's going to happen next, but it's a great lead-in to having a discussion about that tech trade. Coming here to the platform where we've got something much more useful in terms of making good decisions. If you want entries and exits and timeframes, use daily trading ideas. Look, when the broad sentiment is starting to decline, and we've got Russell reconstitution tomorrow, we have the month end, quarter end, June 30. We just had quarterly index rebalances, and there are a lot of patterns and movements that you can look at. Might not be the best time to do it, even though there's an enormous amount of opportunity to trade momentum. That's because there's a lot of volatility in stocks. Even if you don't see it in the VIX, the VIX doesn't always do a good job of capturing how much movement there is. But it comes back to demand and supply. And let's talk about Micron. I said yesterday, you look at it, it was the Hicks rule. Well, what generally happens? Stuff rises. The trouble is it often occurs outside market hours. So here's Micron. Yesterday the data would have been right here, just hitting 10 with declining, 5-day declining supply. Well, I don't know with earnings what's going to happen. You don't know, but that's probably a pretty good indicator to tell you what everybody else thinks. Whether you're a stock picker, a directional leveraged trader, a catalyst trader, the global macro money, the sector money, whatever it's doing, when it has strong demand and falling supply, the probability, all other things being equal, is that the price rises. Now, I don't know how long it'll be. This is the bigger picture to me. This is and I wrote about this too, that this is what we've had. We've had just absolutely pounding demand for Micron. And then the demand slowed, and then it returned, and what didn't last long, and then it dipped lower, and now we've got this one. Now, I don't know what's going to happen. Those things tend to mean the end of something rather than the beginning. Look, I don't know. I'm just basing that on history. And, looking at this data, thousands and thousands and thousands of hours of studying these data, it's a general theme. When you have a long period of demand and then it begins to break down, it doesn't tend to lead immediately into another long period of demand. Now, I don't know. We'll see. But why would that be true? Because the data changes. And if the data changes, all the machines and the humans consuming that data, their behavior might change. Again, I don't know what's going to happen, but we're at inflection points here. Like demand in the market is peaked. It's all fine, but it's the first half of the year. We've got massive index rebalances right in a row. This is the first semi-annual Russell reconstitution. They've done it before, but you have to go back decades. Not under this current regulatory and market structure regime has Russell done a semi-annual. We'll do this reconstitution and another in December. So it's unusual. And I don't know what that means, but just beware that there are things in the cadence and the calendar of the market that could disrupt flows. Here's SanDisk. Well, again, you'd look at it and say, well, it's probably going to rise. You get very strong demand, even with this big dip. Strong demand, falling supply generally means that you're going to get gains. The question is it the end or the beginning? I don't know, but it looks just like Micron. And I think, well, I wouldn't trust this bounce. I don't know what's going to happen, but I would want to get into the second half of the year before and get a better look at how demand is holding up. But we know that these conditions produce gains. The question is it short or are we entering another one of these? I don't know. It seems improbable to me, but who knows? Maybe we are. You can look at all of these ones that have been core drivers and see what they tell you about what has been occurring. And you will notice over and over, they look very similar. I mean, the conditions right now are good, right? There's falling supply, demand hitting 10. Probably you get a short-term bounce. I don't know that it's going to be this, though. Is it more like this? Right? I don't know, but it certainly would warrant shortening your time frame. That's how I think about it. So then let's go look at the bigger picture to finish this piece of the puzzle. And I always like to look at this. I look at mega caps, stocks of 100 billion or more in market cap. I can click through, but just note this, it's 139 of them. Yesterday it was 143. So, there was some decay as a result of how the market behaved. So then you can come down and look at big tech. Oops, it just went past it. How does big tech look? Well, it's got very strongly divergent demand and supply, but this is quite weak. I don't know what it's going to do, but this is completely different than it was during the S&P quarterly rebalances in June of 2025 and the Russell reconstitution, when money was rushing headlong into big tech. It is not there. That doesn't mean that it won't show up, but it explains why these are the drag on the S&P 500 right now. There is insufficient demand, and you can say, well, Tim, it appears to be returning to 5. Yes, it may, and it may keep right on going. I don't know, or it could stall. and these two things could reverse. I mean, if you looked at the amount of time this has declined, you'd say, well, it's as long as that. What's the likely next thing to happen? Well, it could rise and demand might stop. Well, without this group, which is like the top 10 or 35% of the entire Russell 3000, well, it's important to know. It's a different condition than existed a year ago. Then you could come down here and look at I look at these things. You look at the tech sector. How does the tech sector look? Fine, right? It had a swale right at June options expirations and the S&P rebalances. It's back over 5, and supply is declining, but it's well over 50%. I mean, I look at that and say, it's fine. It's just kind of like what we saw in that other view. Demand looks fine. But it is coming off of this is a fairly weak period by comparison to this, where, if you took an average, that would be well over 6, maybe 6.5. Here, we're much closer to the baseline. Again, it could change. But on the length of patterns, this could be the top. And if it's the top, that's not enough to boost the market. Then finally, I come down to the semiconductors. I just keep a portfolio. And exactly as you'd expect, just absolutely unremitting demand. And yet, there's the breakdown, right? Supply side looks fine. And is it peaked? Well, it might be. I mean, it might be that this is it. I can't say absolutely, but those are very helpful data points, because unlike most other, things that you would use, technical signals, fundamentals look awesome. I don't know what the technicals look like. I don't use those, but I could tell you from a demand supply perspective, it helps you to understand where you are. And, those things, to me, that's much closer to a top, certainly not the beginning to me of a run. It's why I conclude what I conclude. I'm not, bullish or bearish. It's just, I look at the data and say, well, that's exactly what the data signals is what has played out so far. So if that remains true, this might be short. We'll see. So I'll pause there briefly before going to the next item. Comments, questions, so I can answer them if you've got them. Let me get back to the panel here. Bear with me. Okay, let me go to the chat, which you can all see at the same time. Right. Okay, let me... Joe, good to see you. I previously mentioned tracking the midpoint of stocks. Is there an easy way to track or view that metric? And thank you for that. You've asked this before. In that vein, I mean, this is what we do. This is, but again, behind the scenes, here's a great illustration. This is what Joe's talking about. This chart right here, which we use internally, tells us whether prices of the stocks comprising the S&P 500 are closing above or below the midpoint. So believe it or not, the last 2 days have actually been net buying days. As rugged as they've been versus the preceding 5 days where they were all closed below the midpoint. What that means simply is, there's a high, there's a low, and if you add them up and divide by 2, you get the midpoint. Well, where's the closing price relative to that? It's that simple. So we run that everywhere. And why? Because the market forces prices there. The regulations require which tokenization would change, doing away with the trade-through rule, Rule 611. SEC has proposed it, and we can talk about that if you want. But you've got the bid and the offer, and they're never the same. There's always some kind of tiny spread between them, and the bid cannot be higher than the offer. I can't come in like I could with your house. You put your house in the market and somebody makes an offer and I come over the top, I could offer you more. Can't do that in the stock market. So what happens? Well, it puts the concentration on what lies between the bid and the offer. What is that? The average. It could be floating, pegged, time weighted, volume weighted. There are all kinds of ways. There are hundreds of algorithms that will try to give you derivations of midpoint. Ergo, if you want to know whether money's coming or going, measure midpoint. And how does the reference price, the last price in the price in the last 10 minutes, compare to it? Because it will be a very good indicator of where things are going. So if you looked at this data, what would you conclude? Well, it's not bad, right? And we can see which money's responsible. It's principally right as you would expect. All the green bars are what? Passive investment. We can see it all over the dashboard at Edge. Why would that be true? Indexes are rebalancing. Russell reconstitution, quarterly S&P rebalances. These things are vastly larger than stock picking. Stock picking is 10% of the market's volume. 26% is passive. Machines are 45%. 20% ties to derivatives. That's why stocks can move 20% up or down, like Miller Knoll today, with earnings during this period of time. It's because it's derivatives. So that's how the market works. This is how the stock market actually works. Now, I don't know what's going to happen. I know that these are consequences of money having to concentrate into the close to get the reference price. And it could skew the data because all of these passives are trying to get themselves trued up. They also, by the way, when you have a lot of volatility, there's volatility of 3.1% in the stocks comprising the S&P 500. That can create enormous tracking errors in a portfolio. And that's the problem for, big passive money needs to conform to a benchmark. And so if you have a lot of stocks moving like this, then what do you do to change the standard deviation in your portfolio? You buy stuff that has half that volatility to bring the average down, right? Well, where's the money going to go then? Is it going to go into tech? I don't think so. Let's go back to the platform. But Joe, that's how to get to that measure. The measure is really simple. Take the high average, the high and low of the day, and add them together and divide by 2. That'll give you the midpoint. It's a very simple, crude measure, but we find that there's very little difference. You could do a VWAP, but frankly, it gives you what you need. Okay, what else did I miss? And I want to come back to a point on the platform, but let me just check this. Dan, Amgen. Okay, I will take a look at that. Brad, and I'll come to you. Let's take a look at Amgen. Healthcare looks good, by the way. I mean, right now, if you were going, maybe that's where it's going, right? If you want low volatility, do you go to large cap healthcare? Perhaps, if you're BlackRock, Vanguard, and State Street. So here's Amgen right at 5, and it spends a lot of time at 5. I mean, this skew here is, it's not awesome, but the trend's pretty good. This is above trend, so that might weigh on price. I didn't look at what's happening today, Dan, but I'd look at that and say, particularly if it's a longer term holding, that looks okay. So long as this doesn't get worse, or if demand deteriorates, drops below 5, we'll just get rid of it, right? You can buy it again when it rises above 5, and as long as it's there, you're going to do better. And there's no question that being at 5 is good. It's a great illustration, and it flitted. Oh, here, let's check this. Just an illustration of that. I think it'll pick this up. Just happens to be on my mind. I mean, look at this. Here's a great example. I mean, if you want to own something very stable, now the demand's declining, supply ticked up. This is occurring because of index rebalances. But if, so long as KMB stays at 5 or better, you're likely to have low volatility with gains. And it can offset these dramatic, wild swings we're seeing in the AI trade. Okay, let me get to the last thing, and just interrupt me, just if I miss something. Okay, so I want to just, as I always do, I do it myself every day. I always return to the basics because I think it's a great way to do it. It keeps you focused, right? What do you look at? Look at broad market sentiment. And what's it doing? Well, as expected, remember when we talked last week, I said this is likely to peak. Just on a trend basis, it's not going to go 20 days like it did last time. That was an anomaly. And so likely the cycle will run, call it 8 days. Well, son of a gun, it has. And now supply is declining. So then does that mute the risk here where demand didn't even get to 6? Frankly, demand is not awesome. It's been a supply-driven wild ride in the market. I don't know what's going to happen next, but I do know this is peaked. Generally, these conditions lead to a flat market, not necessarily a declining one. But you know where you are in the cycle. If you're buying here, you're more likely to get a return. And once you get to the peak and supply starts to rise, then what happens? The market turns rocky. It's not a perfect read, but it is predictive. And it's so simple. You don't have to draw patterns and, golden crosses or whatever. And if you're good at that, I'm not mocking it too much. It's just simpler. So look at that. We know this is occurring right into index rebalances and the end of the quarter. So, if you don't want to have a whole bunch of money exposed to that market because we don't know which way it's going to go. Context. Well, I've really covered that, but you can always go back here to Market Structure Edge and look at the calendar. There are many places to get it. You can get it from the Options Clearing Corp. I just go here to the 26 expiration calendar and check it to say, okay, well, what's happening next? What's the thing to be watching for? Well, we know right now it's, the index, the Russell reconstitution. Man, it's taken a long time to open that. This calendar will show you, here's what we just went through in June. All of this stuff, you can see the key at the bottom. There's the next item. Here's Russell reconstitutions. So we'll put it on the calendar. And then July, of course, we'll look at the 16th, 17th, and it's a split week with VIX expirations the 22nd. So, if we peek into this, could be a tough market into the 6th. I don't know. I just know, the market runs in cycles, and I will watch that pretty carefully. And then going back to the platform, you look at divergences. And this is interesting to me. If you just walk through the sectors, which is 100% of the market, communication services, it's fine. I think this is a fine longer term hold, but demand is declining into these rebalances. It tells me that there's not a lot of demand. Consumer discretionary has been pounding. It's been just on fire. But it's declining again. I don't know what's going to happen if it'll, but it's right. It's not on the way up. It's on the way down into these things. Well, you can infer from that, okay, well, passive money is not plowing into consumer discretionary. It's not plowing into consumer staples. The trend on the supply side has been down. But again, do you want to buy that? It's better to better buy this. And then if you're going to reweight, you sell a little bit there, right? Then let's, look at energy. Energy doesn't look great. It's weak demand, high supply, and no surprise there. Financials, they're fine, but they're well above 5. That is a good sector. But again, it's peaked. So you just get a real, healthcare looks the best, right? You look at that tells you this is probably why Novartis and a few other J&J show up in our model portfolio. We're going to pick that up because that's where the money's going. Passive money is apparently, at the moment, in its rebalancing, concentrating on healthcare to blunt the volatility in some of the larger stocks. Industrials look fine too. I would say they're number 2. Industrials tend to be lower volatility. Makes sense. Tech looks fine, but again, is this really strong? The trend on the supply side isn't good, even though the recent 3, 4, 5-day turn is good. These are not, and this is the engine of the market. Would I buy that? Well, it's fine. What I don't know is if it's peaking. Certainly, I'm not going to buy it before the Russell reconstitution or June 30. But you really can get a very good look this way at what's happening. Materials, it's been very good too. It's very strong demand, but again, it's peaked. You can just go see this everywhere. Real estate, it's been surprisingly good. I don't know why it's been good because I can give you a lot of reasons it shouldn't be, but it's declining. So again, I look at that and say, well, I'm not going to buy that. Utilities look good. There's a little too much supply, but demand is very stable. So you think about that. Industrials, healthcare, utilities are the best looking parts of the market. Well, that's curious. So we look at the data and the data just tell us what it tells us. And I'm telling you, that's what passive money has concluded it wants to be in. Now, I don't know what that means for the tech trade, but it's interesting. I leave it to you. What we do is provide data, not advice. But I think that's, it's pretty interesting. Okay, let me do this again so I can see what we've. Yeah, Joe, weak tops precede drops. It's, it's one of our favorite tropes. It's not always true. And what Joe is talking about is, what if demand doesn't get to 6? Well, certainly it means money is not pouring into the market like it was in April and May of 2025. There was the patterns are just huge patterns. We do not see that here. And so I agree. Could be. I can look at the market and give you reasons why it just continues on fine. But did you see the volatility today? But before the market opened, the NASDAQ was up over 750 points. We went out and walked the dog. I came back and it's down 350 points. Do you know that is one of the largest, it's top 4 all-time points move, and it occurred in the space of 20 minutes. Those are not things that happen in markets with pounding demand. Those happen in markets where people are trying to sort out their exposure. So again, the prudent foresee evil and hide themselves. Look at those things and say, well, I'm not going to step in front of that train. I'm just going to wait and see if we see some better signals in the data. Right now, I would say if you're going to have exposure, healthcare, industrials, utilities look pretty good. I would be wary right now of tech because I don't see it there.